I came across this article here on Seeking Alpha from Leo Nielsen, and the article is titled, "The Best Time to Buy Dividend Stocks is Now." I am so excited to share that today's video is presented by Snowball Analytics. Snowball Analytics is a tool that I use to track my dividend income and analyze my portfolio. Whether you're a new or existing Snowball Analytics user, use promo code DGI to get the very best pricing. I want to start off here by saying that I've really enjoyed this article review series that I've had on the channel here on Thursdays, but this is going to be the last video that I'm going to be able to make here on the channel on these Thursday videos. This next year is going to be really busy. I'm going to be traveling a lot. There's going to be a lot going on. I'm just not going to have the time to be able to make a second video a week. It's been something I've been doing for the last about 6 months or so. I've really enjoyed this. I've had a lot of fun with it. It's been, a different take on my channel. It's been very different than the other videos. I just won't have the time, unfortunately, to be able to continue doing this in the next year. But if things change, I will consider bringing it back and doing these again in the future. But for now, this will be the last video of this series going forward. So I really enjoyed this article from Leo. I think he takes a very well-balanced approach at looking at this topic of investing into the stock market, most particularly dividend stocks, when the market's at all-time highs. Because most investors, you kind of think about this kind of counterintuitive. When you look at the stock market, generally, you look at the stock market, you want to see the market up, right? You want to see it only green. But if you're a dividend investor, you really don't want to see that. You want to see the market red. You want to see dividend stocks not at all-time highs because you're not going to get a high forward yield. And Leo does a really good job talking about investing into the market, most particularly into dividend stocks when the market's at all-time highs and valuations are at all-time highs. So he does a really good job with that. And let's take a look at the article. So the summary of the article here is navigating today's market as a dividend investor is challenging due to high valuations, lower yields, and a tough risk-reward environment. I remain committed to high-quality dividend stocks, especially those poised to benefit from potential market rotations. Opportunities exist in undervalued cyclical areas that may gain momentum as economic growth broadens. By staying disciplined, focused, and opportunistic, investors can find attractive long-term investments despite current hurdles. I am Leo Nielsen, and he's part of the iREIT Hoya Capital group here on Seeking Alpha. I think that's what this is part of the Brad Thomas group here on Seeking Alpha. So the introduction of the article, the best time to plant a tree was 20 years ago. The second best time is now. This is a Chinese proverb. There's one huge difference between trading and long-term investing. When trading, we look for good assets, often with a goal of selling it after a few minutes, hours, days, or weeks, depending on your strategy. This can include buying and shorting stocks, futures, and other derivatives. Essentially, it does not matter what the market and or macroeconomic environment looks like. When investing, it's different. For example, I'm currently up more than 100% on 5 investments, 3 of which are up more than 200%. While that's great, I don't really care about it as my job is to put money to work regularly. I won't sell any of these investments as it's a long-term process of putting money to work, not a stock picking competition. Hence, unlike traders, dividend investors are dependent on finding suitable long-term investments in any environment, as our job is to gradually put money to work in assets we don't expect to touch for many years. Now, he's obviously talking about dollar cost averaging and not lump sum investing here. So currently this has become difficult, which is why I'll use this article to explain why the situation has become so tricky and what I'm doing to improve the risk reward of my portfolio. So as we have a lot to discuss, let's get into it. So finding good dividend stocks just became much harder. I have to admit the intro of this article may be a bit vague. My point is, when we're trading, it does not matter if a stock has a decent yield, a wide moat business model, and or tailwinds that will allow it to generate value for many years, decades to come. When trading, all we care about is momentum. This makes dividend investors like me dependent on high quality stocks. In some environments, it's really difficult to find these investments. That's a problem if my goal is to invest, for example, $2,000 per month. I may not always be able to find the right companies. For example, let's say your goal is to invest into dividend stocks with an average yield of 4.5% and a long-term expected dividend growth rate between 2 and 6% per year. Finding these investments in an environment where interest rates are above 4.5% 4.5% is much easier than an environment of subdued yields. Currently, this is becoming an issue. As we can see below, the yields of the Vanguard Dividend Yield Index, VYM, has dropped to just 2.7%. This is one of the lowest numbers over the past 10 years. The Schwab Dividend Equity ETF, SHD, yields 3.3%. This is so spot on, guys. Whenever I was, dollar cost averaging into my portfolio and I would look at the forward yields, whenever I would see VYM below 3.5%, I would never touch it. And the fact that it's below 3% now, a forward dividend yield of less than 3%, that's just mind-blowing to me, because VYM was always kind of the slower grower, and it's just psychologically difficult for me to imagine right now putting a lump sum of money into VYM. Now, if you're dollar cost averaging, that's obviously a whole nother beast, and it's completely different. So if you're dollar cost averaging, the forward yield doesn't matter as much. But if you have a lump sum amount and you're looking at the yields today, it's like, you're like biting your tongue. You don't want to invest into the market right now, because the forward yield is just so low, and it just is a difficult thing to do at these valuations, at least from my perspective. And I would assume if you're a dividend investor, you're probably seeing this the same way. The divergence between these two ETFs is caused by the fact that VYM is slightly in a better spot to benefit from current trends. This includes the strong performance of its biggest holding, Broadcom, and a bigger weighting of financials, technology, and industrials. The same is visible when looking into higher yielding dividend stocks using the Global X Super Dividend US ETF DIV. As an example, the yield of 500 of the highest dividend paying equities in the United States has dropped to 5.6%. That's down from the 7% yield investors were getting earlier this year, with roughly 150 basis points below the 8-year average. Yeah, high yield stocks have really gone up. You look at SIN stocks, look at Altria Group, look at BTI, Philip Morris, look at some of these utility stocks that average around 4% that are now averaging around 3%. Forward yields have dramatically gone down because the share price of these investments have gone up so quickly. And it's really difficult to look at this and see, oh, I'm taking on all of this risk, but I'm getting a low forward yield because the share price is so high. And that's what makes this environment so difficult right now. If you're a dividend investor and you're looking to lump sum, it's very, very challenging right now. Now, if you're dollar cost averaging, it's like, okay, whatever, you're not getting any great deals right now, but you're always buying, so whatever. But it's just important to understand, kind of which situation you're in. Now, in case you're wondering what kind of risk you'll have to take to buy a 5.6% yield, this is what the total return of the DIV ETF looks like. So this ETF is high risk and has underperformed the broader market significantly on a total return basis. So since its inception, it has returned just 65%. So since 2014. That's including dividends, and a mile below the S&P 500's 371% total return during this period. So if you're buying this now, you're not getting a good bargain at all based off of where it's traded historically, right? And so the valuations are just so high, and you're just not getting good. I guess the way that I would dumb this down for me is you're not getting a good bang for your buck. Well, there are many great ways to buy income. It shows that the higher the yield, the bigger the risk. I also discussed this in an article titled Say No to Sucker Yields, 3 Winning Dividends for Savvy Investors. So a company that pays a steady stream of growing dividends is probably in robust financial health, but one that pays a gigantic dividend is probably struggling and may be desperate to attract investors. Put a bunch of those into an ETF and you get a lot of income, but even more risk. So painting with a very broad brush, I think it's fair to say investors now have to take the same risk, with the exception that the yields that they are getting are lower. That's not a great risk reward. Everyone is bullish in an expensive market. One thing I bring up a lot in my articles is the market's valuation. Eager buyers have created a more unfavorable environment for stocks, which pushes down yields and causes valuations to rise. This does not bode well for the future risk reward, as the market's PE ratio suggests a negative total return over the next decade. This is why you have all these economists coming out and saying, hey, we're going to have a lost decade based off of current prices. If you're investing into the market when it has a historically high PE, you're not going to participate in the future growth of the market. And I really love this. This is one of the things that I love from Chuck Carnevale from Fast Graphs here on YouTube. I'm following him for years. One of the things that he would say all the time that resonated with me is that valuations matter because you won't participate in the growth of the company if you buy in at a high valuation. And this is absolutely true when you're looking at the overall market and you're investing into the market via an index fund, an ETF. You're not going to participate in the growth of the market. So we are the third highest valuation on the S&P 500 in modern history, only behind the 1999 and 2000 and 2021. And we all know what happened after those periods, right? So if this valuation upside continues, it leaves forward-looking returns less compelling, says Emily Rowland, the co-chief investment strategist for John Hancock Investment Management. And you can see here, he has a graph here of where we're at in terms of the trailing PE of the S&P 500. So very, very high in modern history. We get a similar picture when looking at the 4P ratio of the market, which also implies a high probability of near zero returns for the next 5 years. This is kind of the reason why you're hearing so many people talk about a lost decade, and it's referencing exactly this because the market is at such high, at such a high valuation that you're not going to participate in the growth of the market because, the market's already at historical high. So there are several reasons that fuel this optimism or elevated valuation. The S&P 500 is top heavy. Because of the massive exposure in the high growth FANG Plus stocks, these have skewed the valuations. As we can see below, excluding the S&P 500's biggest holdings, the market is trading slightly above average instead of at an absurd valuation. This is good news for the risk reward of the average stock on the market. So this is not so great if you have a market cap weighted index like, the S&P 500 or something like that, where it's very top heavy. Another reason here is inflation has come down fairly consistently since last year. This allowed the market to bet on a dovish Fed. As lower rates are great for the discounting future cash flows, rate cuts tend to push money into the market because they're no longer in that safe haven in money markets. In order to get a return, you have to take on more risk. And that's what he's talking about here. And then another reason is the economy is still strong, although growth is not broad-based because of the challenges in cyclical areas like manufacturing. GDP growth is expected to be solid this year with an annualized real GDP estimate of roughly 2.5%. And then another reason is Trump's election victory is expected to fuel GDP growth, supported by measures that could potentially broaden economic growth to cyclical sectors, cause consumer confidence to improve, and economic reshoring to accelerate. So the good news is that if President Trump is successful in boosting cyclical economic growth without causing inflation to reaccelerate, the market could continue to rise, defying some warnings from people who really dislike the current valuation. However, if that were to happen, I expect a major rotation to occur. The biggest bull case hasn't even happened. One of the reasons why I'm still buying dividend stocks is because I do not believe the biggest bull case has yet unfolded. As I've written in plenty of articles this year, the aggressive rate hikes of the Federal Reserve caused short-term rates to rise. This made it very attractive to invest into money market funds, as many income-focused investors got yields of 5% and more without having to invest in dividend stocks. This trend continued even after the Fed cut rates by 75 basis points, as money market funds just surpassed $7 trillion in assets under management. As reported by Bloomberg, the most recent week saw another $91 billion of inflows, bringing the gain since August 1st to more than $400 billion. So guys, if you have any reason to be bullish on the market, it's this right here. Now, you could sit there and say, well, there's so much money in cash and cash reserves or money markets because the real money is scared of a correction, right? And so they're sitting on the sidelines. Yeah, sure, you could say that, and you could have said that for many years. But if you're a fund manager and you're managing billions, trillions in some cases of assets, and you have a mandate to get, 9 to 12% a year, if you're getting a guaranteed 4.5% in a treasury or a money market, why are you going to take unnecessary risk? And that's been the case these last couple of years since the Fed started increasing rates. So the question is, well, once the Fed's fund rate goes down, interest rates go down, all of these, money managers who are holding the real wealth, the 1%, right, that really moves the needle in terms of the market. Well, then these fund managers, they still have that mandate of 9 to 12%. I'm just estimating here. Well, they're going to have to start moving money out of money markets into riskier assets, i.e. the stock market. And so that is what Leo is insinuating here will happen once the rate goes down. Because you have to understand, it doesn't just impact you and me, households, but fund managers that are really managing the wealth of America and the wealth of the world. This is how they're looking at that. And so as a regular person, we don't kind of think about that from that lens, but that's the reality of how the market works, and at least my understanding of it. So take that with a grain of salt as you will, but that's how I view it. So year to date, more than $700 billion has made its way into these funds, so the money market funds. The fact that assets under management are still rising is based on several factors, including, despite rate cuts, money market fund rates are still attractive and close to 5%. It still does not justify taking higher risks for many investors. It is difficult to disagree with that. Money market funds are usually slow to adjust to lower market rates, which tends to create a lagging effect. While it looks like the Fed has taken its foot off the gas when it comes to lowering rates, I believe that further rate cuts could cause a significant rotation from money market funds to high quality dividend stocks. This would further lower the average yield as the market is looking for income in other places. So what am I doing? I have mixed feelings. On the one hand, a lot of my dividend picks are doing very well, especially the higher yielding midstream industry that I've been pounding the table on for a long time has taken off, fueled by Donald Trump's plans to boost oil and gas production. On the other hand, it has caused their yields to crater as companies like Kinder Morgan, KMI, and OKE now yield only 4% and 3.4% respectively. This is not a lot for an industry with a major focus on income. Yeah, these forward rates are very, very low. And if I had a big lump sum of money, I would not be looking to go invest into these midstreams because they are very, very high. Now the question is could they still go up? I have no idea. But looking at this and where they've historically been, right around that 7% range, and they're now cut in half, it hurts to look at that. So as I wrote at the start of this article, this stuff bothers me a lot as it makes putting new money to work a lot harder. The same goes for other stocks as JP Morgan and Bank of America yield just 2.1% and 1.9% respectively. Before this year, investors were able to buy both stocks with yields closer to 3%. Yeah, seeing JP Morgan sub 3% is like, what is this? What is going on? It's just, crazy to think about that. So in light of these challenges, I've become a lot more focused, which means I'm watching my watch list like a hawk. My watch list includes the stocks I cover daily on Seeking Alpha. If I see abnormalities like sell-offs caused by policy-related headlines or other factors, I become a lot more interested. I'm also a lot more aggressive when it comes to stocks that I like. This year, I added 4 new investments to my portfolio. 3 of these are in my top 4 holdings. All 4 are in my top 7. This is a result of the strong performance and the fact that I invested almost all of the excess cash into them. I became aggressive with a goal to buy before the market rotates from growth to value. On top of finding outlier opportunities, I also believe we will see a lot of potential in cyclical areas. Because economic growth has not been broad-based recently, a lot of cyclical dividend stocks have been lagging. This includes industrials, energy, materials, and related. I believe these areas areas offer a lot of opportunity, especially when leading indicators like the ISM Manufacturing Index recover. For now, signs are promising as indicators like the Empire State Manufacturing Surveys are pointing at higher cyclical growth. This could fuel broadening economic growth for the first time since 2021 and unlock a lot of value in areas that have been lagging the market. Hence, that's what I will be focusing on a lot more going forward. In general, despite the poor risk reward of the market, I believe high quality dividend stocks are the place to be for investors with a 10 or more year time horizon. Especially if money market funds start to rotate, I believe the general rotation from growth to value will accelerate. So far this year, I spent most of my time preparing for that, and I will continue to do just that going forward. In other words, stay tuned for a lot more stock picks and discussions of the evolving macro landscape. Well, it's a tricky investment environment. It's also one that can reward investors who pick the right dividend stocks. So the takeaway here, navigating today's market as a dividend investor is increasingly challenging with high valuations, lower yields, and a tough risk-reward environment. Yet, I remain committed to putting my money to work in high-quality dividend stocks, especially those poised to benefit from potential rotations in the market. While yields have dropped across the board, opportunities still exist, especially in undervalued cyclical areas that may gain momentum as economic growth broadens. Moreover, by staying disciplined, focused, and opportunistic, I believe investors can find attractive long-term investments despite these hurdles. Also remember that time in the market beats timing the market. So that's the article. Let's take a look at a few comments. So the first comment here, I'm trying to be bullish on a Trump economy, but it's hard, all I can say. And I like the comment under the comment, be patient, little grasshopper. Do not repeat the error of Paul Krugman and Mark Cuban in 2016. Yeah, I can understand this. I mean, you could say this about any election, about anything, going into the future. It's just part of investing. Okay. The market trades, this has always been my understanding is the market trades off of information over the next 6 to 9 to 12 months into the future, right? And then there's market crashes where things that the market didn't price in, that's where you have a crash, right? So if something were on the horizon where the market could sniff it out, you would see the share price of the market or the valuation of the market go down. But because the market isn't sniffing out any major event, the market's just kind of on autopilot, and every single day, every single week, money's coming in, money's coming out. There's things happening, and that's just how it works. And so for me, because I don't time the market, at least when I was working and, investing while I was working, I was always buying. And it's because of this, because of a comment like this, is one of the main reasons and why I always dollar cost averaged into my portfolio. I didn't care if the market was up or down. I was always buying. Now it becomes much more difficult if you have a lump sum of money. Say you get an inheritance, you sell a business, you sell part, you come into a lump sum of money. It becomes a little bit more difficult. But I do like the saying, it's better to focus on time in the market versus timing the market. Another comment here, I just recently heard an investor bragging on how he sold out of his diversified asset allocation portfolio and put it all in an NVIDIA stock. Could this be a market top signal? Reminds me of the excessive risk taking before the tech stock crash many years ago. And the comments here, yes, 100% sign of a top. You know what this comment reminds me of? Reminds me of The Big Short. Remember when they're in the, what was it? They were in the club, the club, right? And the dancers, right? And then they're bragging and she's like, yeah, I got like 4 condos or 4 houses. And then the next scene is, it's a bubble. It's a bubble. The best scene in the whole show. But yeah, so yes, I can confirm it's a bubble. And then another comment, great article, great minds think alike. I'm the same, always watching, looking to put money to work. Sold some Altria Group for a profit, and it's so hard not throwing it all into Pepsi right now, hoping for a nice dip. Yeah, and he even commented here, Leo commented, yeah, I prefer Pepsi over Altria as well, good move. So yeah, PepsiCo is going down. All of these CPG companies have been going down largely because of RFK and, the scrutiny that's, the market is kind of sniffing out that, RFK is going to come in and, reevaluate, health safety, food safety and all that kind of stuff. So for good reason, stocks like Pepsi and J.M. Schmucker, General Mills, a lot of them are down because, quite frankly, in my opinion, you look at the ingredients 30, 40, 50 years ago of some of these products, and you look at the ingredients today, a lot of these companies, they're poisoning people for profit. And my wife and I, we have entirely changed our eating habits. Like, we're cooking a lot more food at home. Like, for example, we don't buy those little dino nuggets and chicken nuggets packaged, full of preservatives at the store anymore. My wife looked up a recipe to make chicken nuggets at home with real chicken meat, organic meat, that's not much more expensive if you buy it at bulk, right? You can get it at Sam's or Costco or wherever. And we're doing that. And what we're focusing on is food choices that have us, one, we can pronounce the ingredients, and two, that there's only a small handful of ingredients. What I would encourage you to do when you go to the store next, go look at your bread aisle. Go look at the bread and look at the back and look at all the ingredients in a loaf of bread. Like, you'll be amazed at how many ingredients are in a loaf of bread. When you make bread at home, there's like 4, maybe 5 ingredients max if you're just making generic bread. Right? Go and look at how many ingredients are in a loaf of bread at the grocery store. It will shock you. Okay. Now, we don't make our own bread, but what we do is we look for, local bread that is made here locally, or where you can buy it at the supermarket and they sell it here local, and they only have a handful, like 4 or 5 ingredients. And so we don't make our own bread, we buy it, but now we're aware of the reality of what's happening. And so I kind of went off on a rant that's not really has to do with the video here, but I guess what it shows you is, and I'm a millennial, I'm a little bit of an older millennial, that consumer behavior is changing and shifting more towards a healthier lifestyle. And that consumer behavior trend can have an impact on your stocks. Okay, so tying it in here to dividend investing. And so when I look at Pepsi, yes, it is trading, it has a good forward yield compared to how it's been historically, but maybe there's a reason for that. And Pepsi, they're going to be fine. They're probably going to have to get sneakier at hiding their poor ingredients, and they're going to have to do some things to just cut corners, but just enough to meet the regulation and the scrutiny that's going to be coming their way. I'm sure they'll do that, but it may have an impact on their earnings, and maybe they're not going to be able to grow their dividend at 7% a year, but maybe only 4% a year. And that changes the valuation. And so things to consider. But overall, a good comment and something to consider when you're investing into stocks. And that's why I always say stocks are great until they're not great anymore. And that's why I love investing in the simple path to wealth with dividend investing, where I invest into a core and satellite portfolio of SCHD, DGRO, and that's what I talk about on my channel. And that's one more reason why I love investing in the simple path to wealth with dividend investing, which was inspired by J.L. Collins. So that's the article. Overall, I give the article an A. I think Leo does a really great job at explaining the dilemma that we have here as dividend investors when the market's at all-time highs, but you still want to be invested. You don't want to try to time the market. And I love the quote at the end, focusing on time in the market versus timing the market. So I hope that you found the video helpful. I hope that you enjoyed this series. Like I said at the beginning of this video, this is going to be the last video of this series, and I will see you as always on my videos here going forward on Sunday. Thank you so much for watching, and I'll see everybody in next week's video on Sunday.